Most traders think options are risky and complicated. But the truth is, once you understand how they actually work, options become the most powerful tool to generate passive income and multiply small accounts. Now, I know options sound super intimidating and scary, but it really isn't once you break it down step by step. In this video, I'm going to simplify it completely. In this full guide to trading options, we will cover what options actually are, how they work, how to read an option chain, and how to pick the right strike price and expiry date. And I will even show you some live examples and profitable strategies that you can use. By the end of this video, you will understand exactly how traders use options to control risk, leverage their capital, and make money in up, down, or even sideways markets. So grab a pen and a notebook. Let's begin. Now, let's start with the basics. What exactly is an option? An option is simply a contract. It gives you the right, not the obligation, to buy or sell a stock at a specific price before a specific date. There are only two types that you need to know: a call option and a put option. A call option gives you the right to buy a stock. A put option gives you the right to sell a stock. Now, once again, you're not buying the stock itself. You're buying the potential to act on it later. For example, imagine Apple stock is at $260 right now. If you buy a call option, you're basically saying that, I think Apple will go up. If you buy a put option, you're basically saying, I think Apple will go down. So options are really just bets on trend direction. But unlike gambling, like rolling a dice or playing blackjack or freaking playing the roulette wheel, options are actually structured. They're defined. And your risk is limited to what you pay. Think of them as tickets. You're not buying the stock itself. You're buying the potential to act on it later if the price moves your way. Now, before we dive deeper into the nuances of options, you might be thinking, why listen to this handsome, jacked Asian multi-millionaire who's always wearing a black hoodie? Well, my name is Brad Goh, and I've been trading for nearly 7 years. And this year alone, I've already crossed over $1 million in trading profits. Every single trade documented live on my second channel, Brad Trade. In addition to that, I've also helped hundreds of students become six-figure funded traders. In fact, we are the only mentorship program with an endless scroll of real student results and a 4.8 star on Trustpilot. And I forgot to put here, but I also have like a $2 million investment portfolio. So, I don't want your money. I want you to become a better trader. Everything you're about to learn today is better tested. My goal here isn't to sell you hype or sell you sickness, right? It's to make you actually understand how options work so you can trade them confidently and safely. So why even bother trading options when you can just trade stocks, which is like a lot more simpler and less complex? First of all, leverage. Options let you control a big position with a small amount of money. For example, instead of spending $26,000 to buy 100 shares of Apple, you could spend maybe $500 to $1,000 to control that exact same exposure through an option. Second, flexibility. You can make money when the market goes up, down, and even sideways, depending on how you structure your trade. Right now, at the time of recording this, the stock market has just crashed because of Trump. And it's actually in this sideways market right now. And a lot of investors who are just holding stocks, they can't do anything, right? Other than just maybe dollar cost average in. But if you understand how to trade options, you can learn how to profit in a sideways market, in a market where your stocks are actually going down as well. So it gives you like more room to breathe. Third, risk control. When you buy an option, your maximum loss is fixed. You can't lose more than the premium that you paid, right? Which means that you literally have limited downside and unlimited upside. It's like risking $1,000 to make $10,000 or even $50,000. That's what it means to have an asymmetric risk to reward ratio. But just like all good things, there's a catch. There's a price you have to pay. Options comes with complexity. Their value changes with time, volatility, and price movement. And this is exactly why most beginners lose. Not because options are bad, but because they don't understand what drives their prices. But once you do, you will see why options are one of the most powerful tools in trading. It's like finding out how the magician performs his sleight of hand tricks, alright? Now let's break it down side by side. When you buy stocks, you are owning a piece of the company. So if the price goes up, you make money. If it goes down, you lose. It's simple. But you do need a lot of capital. When you trade options, you're not owning the stock. You're just renting potential. And you can get the same exact exposure for a fraction of the cost. And then stocks also move dollar for dollar, while options move a lot faster because of leverage. A small move in the stock price can cause a large percentage move in your option. But here's the trade-off. Stocks don't expire, options do. Each option contract has a timer. So if the move doesn't happen soon enough, the option loses its value over time. So basically, stocks require more capital, but it offers ownership and unlimited time. While options need less capital and provide leverage, which means high risk, high reward, but it comes with expiration dates and it can expire worthless. So I want you to think of it this way. Stocks is like owning a house. Options is like renting the house for a few months, hoping the price goes up before your lease expires. The key takeaway here is that options are not better or worse. They are just a different tool. They're just a different asset or instrument, right? It's like comparing apples and oranges. But if you use it correctly, they let you profit with less capital and defined risk, limited downside. Now, before we dive into the charts or the option chain, you need to understand a few key terms, because once this click, everything else will make sense, right? Like you will be able to understand what I'm saying throughout the rest of this video. First one is strike price. This is the price level where your option gives you the right to buy or sell the stock. For example, if Apple is trading at $260 and you buy a call with a $264 as the strike price, you are saying, I think Apple will move above 264 before expiry. So it's basically your target price. Next is expiration date. Like I said earlier, every option has a timer on it. And once that date passes, the contract expires. You can choose short expiries like a few days or longer ones like a few weeks or months. Shorter expiries are cheaper but riskier because you have less time for your idea to play out. Longer expiries cost you a lot more, but it gives you more breathing room. What I'm trying to say is that it's essentially like a ticking bomb, but you get to choose what timer is on the bomb before you actually explode. Third is premium. This is simply the price of the option, which is the amount you pay to buy the option. So if the premium is $5, that means you are buying $500 for one contract because each option represents 100 shares. All right, so unlike stocks, you can't just buy like one share of a stock. In options, you have to buy a minimum of one contract, which comprises of 100 shares. And 100 shares times the premium, which is the price of the option, that gives you the cost that you have to incur in order to actually buy that option, in order to participate in the game of option trading. And lastly, underlying asset. That just means the stock or index the option is based on, like Apple, Tesla, or SPY. So when you buy an option, once again, you're not buying the stock itself, you're buying a contract that is linked to it. Once you understand these 4 different terminologies, you can already start making sense of an option chain. Let me just give you a quick example that you can see on the screen right now on the right-hand side. So in this particular case, let's say I want to buy Apple, all right? I want to buy an option on Apple. So that's the underlying asset. That's the stock that I'm betting on. I'm betting that maybe Apple will go up. So as a result, what I want to do is that I want to buy a call option. And then the strike price that I want to buy is, let's say, $260. So this is my target price, right? This is the target that I want the stock price of Apple to reach to before my contract actually expires. And then the expiration date that I choose is October 31st, right? Which also means that after this date, your option automatically becomes worthless if you don't exercise it. And then the premium I pay in this particular scenario is $5 per share, which means I have to buy 100 shares. That's equal to one contract. That equates to around $500. So my option contract in this particular case is buy call Apple at 260 at $5 per share, and this contract expires on October 31st. All right, now let's go a little deeper with a few more terms that you'll see everywhere. First, in the money. This means the option already has a real value. For a call, that's when the stock price is above your strike. For a put, that's when the stock price is below your strike. In the money, options are much more safer because they already have some built-in value, but they always cost more. And then we got out of the money, which is the opposite. These are cheaper but riskier. Once again, they don't have any real value yet, and they only become profitable if the stock moves past your strike price before the expiry date. And then we got at the money. This is the strike price that is closest to the current stock price. It's like the midpoint, right? You know, you got like a balance, risk, and also reward. Basically, it's the price that is nearest to the current stock price. That's it. Next is volume and open interest. Volume shows how many contracts were traded today. Open interest shows how many contracts are still active in the market. And the higher these numbers, the more liquid that option is, meaning it's easier to actually enter and exit at a fair price. Finally, we got break-even price. This is the point where your trade neither make nor loses money at expiry. And for calls, this is the strike plus premium. And for puts, it's your strike minus premium. So if you buy a 260 call at $5, your break-even is $265. So these are pretty much the building blocks of every option trade. Once you get comfortable with these terms, reading an option chain and placing trades becomes 10 times easier because you will finally understand what every number on the screen actually means. So let's look at an example on the screen right now. Let's say you want to buy call options on Apple and the current price of Apple stock is $260. So that's the at the money, right? That's the price. If the strike price is 260, that means it's at the money. Now, if it's lesser than that, that means 240 or 250. This means that it's in the money, right? So it's already profitable since we are already at 260. And then if it's 270 or 280, which is above the price right now, this means we are out of the money, right? So it's obviously the price is not yet profitable because of the fact that we are not there yet. So very simple, when you're buying call, in the money means the strike price is below the current price, the current stock price, and out of the money basically means that the strike price is above the current stock price. That's for call options. And then for put options, it's the exact opposite. So how do option prices actually move? Well, they're made up of two different parts, intrinsic value and time value. Intrinsic value is simple. It's how much your option is already in the money. If Apple's at 265 and you own the 260 call, it has $5 of intrinsic value. Once again, it's the difference between the strike price and the current stock price. Time value is what you're paying for the chance the stock move further before expiry. Now, once again, we will talk more about all these different variables later on. But for now, just know this one thing. As time passes, that time value slowly melts away. And this is called theta decay, okay? It's pretty much the asset just decaying over time. Every day your option loses a bit of its time value. And that's why short-term options are cheaper. They have less time left. They are less valuable in some way, shape or form. Pricing is also influenced by volatility and interest rates. But like I said, we'll cover this later on. Now, if you're a beginner, just focus on this one thing. The more time you buy, the more expensive the option is. The closer you are to expiry date, the faster it decays. So timing isn't just important in options, it's everything. Like we got this adage in Wall Street which says that being right early is just as bad as being wrong. And that really applies here. So before we dive into each one of these variables, let's look at some more examples. Now here's an example of a call option in action. Let's say today you buy a call on Apple at $180 as a strike price for around $5. Now, that just costs you $500 since each contract controls 100 shares. 100 times $5 equal $500. Hope you're still with me. Baby science, baby math. If Apple rises from $180, which is the current stock price, to around $190 before this contract expires, your option will now be worth around $10. So you make $500 profit, which is 100% return. Happy days. But if Apple stock stays below $180, the option expires worthless and you end up losing the $500 premium, right? The premium that you actually paid to participate in the game of like trading this particular option. So the key idea here is this. Buying calls is a bullish strategy. You're pretty much betting that the stock will go up and your risk is limited to the premium that you paid. Right? Like once again, that's the fee that you pay in order to participate in this game. But your upside is theoretically unlimited. So for example, in this case, if Apple goes up to $200 or you go up to like $1,000, your profit will just keep on multiplying. And that's what makes calls so powerful, right? You define your risk and you still get full exposure to the upside before the contract actually expired. So limited downside, unlimited upside, good shit. Next, we got put options. Right, let's flip it this time around. Put options is basically the opposite. So this time around, you are betting that particular asset is gonna go down. And imagine Tesla is trading at around $250 right now. So you decide to buy one 250 put for $6 as the premium price. So $6 times 100 shares, that's $600 trade, right? You are literally paying $600 to actually play this game right here. This gives you the right to sell Tesla at $250, even if the market drops, okay? So if Tesla later fall to $230, right, from around $250, now your put is worth around $20, which means you have just made 1.4K in profit. But if Tesla stays above $250, the option expires worthless and you lose the $600 you pay, right, which is the premium price, right? And that is, once again, the fee you actually paid to bet on the fact that Tesla is going to drop. So quite simply put, get it? No pun intended. Buying puts is a bearish strategy. You profit from price dropping. And just like calls, your maximum loss is only the premium that you paid, right? Which is insanely good. And I forgot to mention this, but there is also such thing as your break-even price, which is pretty much your strike price minus your premium price. So in this particular case, it's around the $244. So if price actually get down to $244, you actually end up break even, right? So you don't profit or you don't lose. Once again, this is before the contract actually expired. And the good thing about buying calls and puts is that you're really getting defined risk, like limited downside, which is just like the premium that you actually pay, but you get very high upside, right? You get high profit potential if the entire trade idea actually played out. All right, before I move forward, let's recap this in just one sentence or two. Calls make you money when the stock price goes up. Puts make you money when the stock price goes down. That's it. You don't need to complicate this. Calls are for bullish traders when you believe the stock is going to go up. Puts are for bearish traders when you think it's going to go down. And once again, in both cases, you're not owning the stock. You're just renting the right to buy or sell at a specific price before a deadline, which is the contract, the option expiry date. Now that you understand the basics, which I like to call the baby steps, let's talk about something that confuses almost every single beginner option trader. And if you don't understand this, you will lose money. I can triple guarantee that you will lose money if you don't actually pay attention to what I'm sharing with you right now. So these are what we call the Greeks, right? I'm not talking about Zeus, not talking about Atlas, not talking about the Greek gods, right? But the Greek in options. The Greeks simply measure how sensitive your option price is to different factors. There are 5 main ones. Delta, which is how much your option price changes when the stock moves. Gamma, how delta changes as the stock moves. Theta, which is how much value your option loses over time, which is the time decay. Vega, which is how much your option reacts to volatility. And Rho, how interest rates affect the price. Now, once again, this might sound super duper complicated and complex, like what the hell are you talking about, Brad? But I want you to think of each one of these as control panel of your option. Delta is your steering wheel. Gamma is your accelerator. Theta is your clock. Vega is your heart rate monitor. And Rho is just the background environment. Once you understand these 5, you will know exactly why your option prices move, not just that it moves. Now let's dive deeper into each one of these factors because this is so important. First, let's look at delta, which I like to call the steering wheel. Delta tells you how much your option price will move when the stock moves $1. For example, if a call option has a delta of 0.5 and the stock moves up to $1, your option goes up by around 50 cents, right? 0.5, right? It's pretty much the same as your delta. Higher delta means your option behaves more like the stock, which means it's more responsive. Lower delta means it reacts less, but it's also cheaper. Now, using this particular logic, that means calls will have positive delta because they gain when the stock rises. And then puts will have negative delta because they gain when the stock drops. Also, when you're buying options, delta also roughly tells you your probability of profit. A delta of 0.7 means about a 70% chance that your option finishes in the money by expiry, right? Once again, we'll go through this later on Interactive Brokers, which is the trading platform that we're going to be using to trade options. Anyways, I want to think of delta as like the sensitivity setting on your car steering wheel. The higher it is, the faster your option reacts to every small move. The faster the car reacts to every single small turn in the steering wheel, all right? Next is gamma, your accelerator. Gamma measures how fast your delta changes as the stock moves. So let's say you buy a call with a delta of 0.5. If the stock rises, delta might increase to 0.6 or 0.7. So that change from 0.5 to 0.7 is caused by gamma. So think of delta as speed and gamma as acceleration. High gamma means your delta is changing very quickly, usually in short-term options which is closer to expiry date. And this is also why like near expiry options can move insanely fast. Like a small price move can cause a huge shift in value because of gamma. Once again, it just tells you how sensitive your option becomes as price move near your strike price. So, a pretty simple analogy, think of it like pressing the gas pedal on a Porsche. The more you press on it, the faster delta accelerates and the faster the car goes, right? So in this particular case, the car is sort of delta, right? And gamma is you pressing on the gas pedal as hard as you humanly can, right? But remember, high gamma also means higher risk because the car can speed up and spin out faster if you're wrong. Theta is one of the most important Greeks and the one that silently kills most beginners because everybody just thinking that, oh, if I just buy a call, I'm just betting that price is going to go up, right? But what you fail to realize is that option start to decay every single day that the price doesn't go up, right? Theta is basically a time decay. It pretty much measures how much value your option loses each day as it approaches expiry date. Every single day, your option loses a bit of value, even if the stock doesn't move. This is why you can be right about the direction, but still lose money if you're too early or too late. You can have the right trade idea, the best entry possible, but if you're wrong about the timing, you're going to lose because of Theta. Short-term options lose value faster, and this is why day traders love them, but investors hate them. Long-term options decay a little bit more slower, right? Because they give you the time to be. On the other hand, long-term options decay slower. They give you the time to be right. So it's much more better if you are a position trader or even a swing trader or like a long-term investor that is betting on a particular trend direction. So Theta is like your clock. It's always ticking, always eating into your premium. If you buy options, Theta hurts you. If you sell options, Theta helps you. So here's an even simple analogy. Think of Theta like an ice cube that is melting. Every hour that passes, a little more disappears. Eventually, the solid ice cube will turn into liquid, and that is when the option has expired. Now, the reason why I'm sharing with you guys these analogies is really to like simplify these concepts in a way where like a 5-year-old can understand. Because I fundamentally believe that simplicity is the highest intellect. I'm not here to try to sound clever. I'm here to try to sound clear, right? So bear with me with these simple analogies. Now, Vega, this is your volatility meter. Vega basically measures how much your option prices change when volatility changes. When the market gets wild, Vega goes up, which means options get more expensive. When things come down, Vega goes down and options get cheaper. And a good way for you to remember this is think about the word Vega. What is the first place that comes to your mind? Las Vegas. Vega, Vegas. And in Las Vegas, it's super duper wild, right? So the more wild Las Vegas is, the higher the Vega. Same thing right here. When the markets becomes wild, becomes more volatile, more volatility, Vega goes up. And then when volatility decreases, Vega goes down. For example, before a company report earnings, volatility usually tends to spike up because everybody is going to be betting that price is going to move up tremendously or move down tremendously depending on the earnings being reported. And this also means that options will become more pricey. Now, after the earnings actually comes out, volatility drops because now there is lesser traders in the market betting on the future of price. And this means that option prices also fall as well. So Vega tells you how sensitive your option is to fear and excitement in the market, which is the volatility. So I want to think of it like a heartbeat monitor. It spikes up during volatility and it slows down after the calm. Finally, we have Rho, the least talked about Greek. Rho measures how much your option price changes when interest rate change. It's a smaller factor for short-term trades. Honestly, it doesn't really matter for us short-term traders, but it can matter for long-term options. When interest rates rise, call prices tend to go up slightly, and put prices tend to drop slightly. It's very subtle, but when you are holding long-term options for months, for years, right? It's very subtle, but when you're holding long-term options for months, these small effects adds up, right? So I want to think of Rho like the background climate. It doesn't really change your drive today, but over time, it shifts the environment that you are trading in. All right, let's tie everything together. This table right here gives you a bird's eye view of the 5 Greeks and what they actually mean in practical terms. Starting with delta, that's basically your steering wheel. It measures how sensitive your option is to stock price movement. And traders, they use delta when they want directional plays. Basically when they are betting on the stock going up or down. Just remember, delta changes as the stock moves, right? So it's not fixed. Next, we got gamma, which is your accelerator. Gamma tells you how fast delta is changing. It's especially important in fast-moving stocks or near expiry because the smaller the time left, the faster your delta can jump. And once again, it works both ways as well. If you are right, gamma helps you. If you're wrong, it punishes you just as fast. And then we got theta, which is a ticking clock. It pretty much measures how much value your option loses each day due to time decay. Option sellers love theta because it means they earn money as time passes. But if you're buying options, theta is that silent enemy. It speeds up as expiry gets closer. And then we got Vega, which is your volatility meter. This measures how much your option prices change when volatility in the market rises or falls. When volatility spikes, like during earnings or major news release, options tends to get more expensive. When volatility drops, they lose value quickly. And finally, we got Rho, which is the interest rate dial. It measures how sensitive your option is to interest rate changes. It's tiny for short-term options, but it can matter a lot for like long-term contracts, which is something that we call LIPS. So the main thing to remember is that all 5 of these Greeks, they interact together. So here's the bottom line. Delta and gamma is like Bonnie and Clyde, right? They work together. Delta is your speed, gamma is your acceleration. Theta is your enemy if you buy options, and your friend if you sell them. Vega spikes during events like earnings or news events, and then it drops after. Rho, usually ignorable unless you are trading long-dated options. Now, the sweet spot for beginners is understanding how time and volatility affect your trade. Because most traders doesn't lose because they are wrong about the trend direction. They lose because they are wrong on timing. And once you master the Greeks, you'll finally know what you are really betting on. And by the way, here's a pro tip. At the money options, we have the highest gamma and Vega, making them the most sensitive to move and volatility. So if you know what you're doing, wink wink. Now let's connect all of this to how you actually trade options, like buying versus selling. When you buy a call, you profit when price goes up. When you buy a put, you profit when price goes down. Now, when you sell a call, you are betting the price stays the same or it will fall. Your profit is limited to the premium that you receive, okay? But your risk is theoretically unlimited if the stock explodes upward. So you don't get to actually enjoy the upside. And when you sell a put, you are betting the stock stays flat or rises. So you will earn the premium, but your risk is high if the stock actually crashes. So remember this one rule. Buyers, they have limited risk and unlimited reward. Sellers have limited reward and high risk because they collect the premium, while buyers, they actually pay the premium. So please, always know which side of the equation you're on before you hit confirm on the buy and sell button. Now, before we jump into the live example, let's quickly talk about the tools you can use for options trading. My personal favorite and the one I'll be showing you today is Interactive Brokers. This is the one that I use to trade options, futures, forex, and even stocks. It gives you one of the most detailed option chains out there with access to Delta, Theta, Vega, and all the Greeks right on your screen, which once again, I'll show you later on. And if you're based in US, Thinkorswim is actually quite good as well, right? It's another amazing platform. It's great for analysis, paper trading, and understanding how different strategies behave. And for complete beginners, you're much better off to start off with tastytrade because it has one of the most simplest UIs to learn from, right? Like you can literally visualize strategies and understand risk and reward instantly. And then we got TradingView, which I mainly use for charting and analyze my different watch lists, my different assets. And I just like keeping my technicals and executions separate, right? Because I just like the charting interface on TradingView. So I use TradingView for charting and analysis, and I use Interactive Broker for execution of the trade. And finally, if you want to learn option strategies visually, tools like OptionStrat is actually quite good, right? They let you experiment with like different combinations before you actually risk your real capital. Now that you understand how options work conceptually, let's apply what we have learned. Let's look at a real example. Let's head over to Interactive Brokers and I'll show you how to read the option chain, how to identify which strike and expiry makes sense, and how to avoid beginner traps when entering orders. This is where we turn theory into execution. Okay, so right now we are in Interactive Brokers. I'm not gonna walk you through like every single part of this platform because this is not an Interactive Brokers walkthrough, but I just want to show you how I actually execute trades on options on Interactive Brokers, right? So let's say we are looking at Apple stock. Okay, first thing, go to option chain, and this is where you can see pretty much all the calls, the puts, the strike price, so on and so forth, right? There you have it. Okay, so this is what we call the option chain. On the left-hand side, we got the call options. That's pretty much betting the stock is going to go up. And then on the right-hand side, we got the put options, which is betting the stock is going to go down. And then in the middle, we got the strike prices, which is basically the levels you are betting the stock will move beyond before expiration. And then on top here, we got the different expiration date for each particular contract, right? So you can pretty much choose which one you want to trade. So right now, at the time of recording, Apple stock price is actually at 265.66. And if you look below here, you will see that there is bid price and ask price for call options and bid price and ask price for put options. The bid price is basically what buyers of the options are offering to pay right now. And the ask price is what sellers of the options are asking for right now. And the real market price is usually around the middle, right, which is the mid price. So you 10.25 plus 10.5 divided by 2, that is where you get the mid price. And then the last price over here just shows you the last trade that went through. Okay, but don't confuse it with the current value, because if the volume is low or the market is closed, this number can be super duper outdated. So always focus on the bid and ask range rather than the last price right here. Now let's look at the delta column. This number basically tells you how much the option moved when the stock moved by $1. So if we look at the 255 call, it has a delta of 0.78. This means every $1 Apple move up, this option gains about 0.78. And once again, it also tells you the probability of expiring in the money, which is roughly 43%, as you can see right here. So delta is both a sensitivity and a probability gauge. Now bringing back the concept of in the money versus out the money. Right now, the share price is 265.66, which means that anything that is below that price right now, it's in the money. So this, in the money, in the money, in the money, in the money, in the money. And then anything that is above 265.66, that's out the money, right? So all of this is out the money right here. So if it's in the money, it's safer. We have higher delta. There's a higher probability of our trade actually working out, but it's also more expensive. So if you want a safer bet, go with the option with a strike price that is in the money, right? So it's like everything below 265 or is at 265. And then if you want leverage or like a quick upside pop, then you can pick those that is out the money, right? But just know that it's more lower probability compared to those trades that is in the money. And then we got gamma, which we have went through earlier, is pretty much like the acceleration. And the good thing about the Interactive Brokers platform is that it allows you to see every single Greek right here, right? You can see the delta, you can see the gamma, you can see the Vega, Theta, and rho, right? So all the information that you need is in here. All right, so let's say I want to buy one contract of the 255 call. So one contract basically equates to 100 shares, right? It's like by default, when you come here, you see they allow you to choose like the quantity, which is the number of contracts that you want to purchase. So 10 contracts means 10 contracts of 100 shares. That's about like 1,000 shares. So in this particular case, I'll probably select like one contract right here. Okay, so this will probably cost me about $1,000 because of the fact that the price I'll be paying to participate in this game, right, the premium price is $10.30. Now, once again, if I'm thinking that Apple stock is going to go up, I'm going to buy a call, right? So that is why I'm on buy order right here on a call. Just to walk you through quickly, like every single button that you can see right here, quantity is basically the number of contracts, okay? So one contract equal 100 shares, like what I just mentioned. 10 means what? 1,000 shares. Okay, so let's go with 1. And then you get to choose limit price, market price, or stop order, right? So market price is pretty much the price right now, okay? But limit price is pretty much how much you're willing to pay for per share itself. So if you're not willing to actually enter at this particular market price, you can just set like a limit price, like let's say at 10.35. And then eventually when price gets down to 10.35, then you'll be tapped into the trade. And then we got time enforced. This tells the system how long to keep your order active. Day pretty much means that the system will cancel your order at market close if it doesn't fill. Good till cancelled means that the order stays open until it fills or until you manually go and cancel it. Okay, so once again, the process is really simple once you get it. First of all, you want to pick your strike based on how confident you are. And then you want to check delta for probability and check bid and ask for liquidity, right? Because you don't want the bid and ask spread to be way too wide because it'll be quite illiquid and you will get in at like a bad price. And then you want to choose your expiry based on how much time you want to be right. So if I'm betting 265.66 will get to, let's say, $270, right? That's the target price. Then the next question becomes, how long should that prediction take to play out, right? Like, is it 4 days? Is it 11 days? Is it 18 days whatsoever, right? So this is pretty much where you determine the time left on your ticking bomb. And then once you're good, you just come in here and select whether you buy call, buy put, or sell put. And then just put your quantity in here, right here. You set a limit that is near the mid price, or you can just place a market order. And then you choose your time in force, which is usually day or good to cancel if you are more of like a swing trader. And then just press submit right here, transmit right here. You can see the order has been submitted. That's it, okay? That's it. That's pretty much how you go from pulling up interactive brokers to executing a trade on options. So in this particular case, you're not gambling, you're structuring a defined risk bet with math behind it. And oh, before I forgot, there's one extra tip, and that is to check the bid and ask spread. If the bid and ask difference is way too wide, like let's say this is $10 and this is like $11, right? Hypothetical scenario, that's illiquid, right? Which means your order might feel poorly and you will get in at like a bad price. So you're much better off sticking to tight spreads with decent volume, especially for beginners. All right, so that's how you actually place an option trade inside interactive brokers. From picking your strike price and the expiry date to setting the limit price to choosing your time in force. But here's the truth. Clicking buy or sell is the easy part. What really matters is why you are placing that trade. Because options are like tools. They can protect you, they can pay you, or they can amplify your returns. But only if you use the right one for the right situation. So now let's go through the 5 most important option strategies every beginner should know. Strategies that will help you understand how to use these options to generate income, protect your investment portfolio, or trade any direction with limited risk. The first strategy is called the long call. This is probably the most popular strategy for beginners. You buy a call when you expect the stock to go up. So let's say Apple's trading at $260 and you buy a $265 call for $5. If Apple eventually climbs above $270, your option just became profitable. You have doubled your money with a very small upfront cost. And the key here is timing, because options have expiry dates. Every day that passes slowly eats into your premium. That's Theta decay, which we have already went through, right? So if you are betting that price is going to go up, you want to make sure that you choose an expiry date that is enough for that move to actually happen. So only use long calls when you are very confident that the move will happen soon. Think of it like renting a stock for a few weeks. It's way cheaper than buying it outright, but like I said, you have an expiration date. So that's something that you want to be careful of for this strategy, right? It's not just as simple as, oh, I'm just going to buy because I think price is going to go up. No, you have to take into account the time decay. Next is the long put. The long put is the opposite. It's how you profit when a stock goes down. So instead of shorting shares, you just buy a put option. For example, in this particular case, let's say you buy a $250 put on Tesla for $5. So if Tesla drops to $240, that put becomes worth around $10, which means you just doubled your money while risking only $5 a share. To me, I feel like this is the cleanest way to trade bearish setups, right? There is no margin, no borrowing stock to short it whatsoever. But once again, time decay is the enemy here. If the stock doesn't move fast enough, you can still lose the premium. So I would advise you to use it when the momentum is shifting down, right? When there's like a very clear bearish trend direction and the market is definitely heading down. Not when you are guessing, not when you are predicting the top or bottom of the market. No, you have to be very, very sure. So let's say you own Apple stock at $260, but instead of just letting it sit there, what if you could earn some extra passive income from it every single month? That's exactly what a covered call lets you do. It's one of the simplest and safest ways to make money using options. So here's how it works. Let's say you already own 100 shares of Apple at $260. Now, you sell one call option with a strike price that is slightly above that. So let's say $270 for a $5 premium. The $5 per share or $500 total, because it's 100 shares for one contract, it goes straight into your account the moment you sell the option. It's yours to keep no matter what happens next, right? So it's like free money, okay? Now, I want you to look at the chart next. The gray dashed line you can see right here, it shows you what happens if you just own the stock, right? If you just own Apple stock alone, obviously you will profit as the stock price of Apple goes up. But look at the green line. The green line is your covered call. Notice how it starts higher. That's because of the $5 premium you already collected upfront. So if Apple stays below $270 before expiration, the option expires worthless and you still keep that $5 profit while still holding your shares. Like I said, it's like free money. It's like getting paid rent just for owning the stock. But there is no free lunch in this world, right? So here's the trade-off. Look at how the line just flattens out after $270. This means that if Apple skyrockets to $280 or $300 or $290, your shares get caught away at $270. So you don't have that unlimited upside like what long call does for you. So this means that you will still make a total of $15 per share, which is $10 from the stock gain and $5 from premium. But you won't profit beyond that. So in this particular case, you have traded unlimited upside, which you usually get on a long call position for guaranteed income, right? So it's like trading capital appreciation for the dividend. Yes, that's a pretty decent analogy. So here are your two outcomes. Apple stays below $270, which means you keep your shares and the $5 premium. The next scenario is Apple goes above $270. Now your shares get sold, but you still lock in a solid $15 total gain. So either way, you walk away profitable. Just that, once again, you don't have that huge upside if price decide to go crazy and go bananas and go up to like $300 or $400. So the covered call is perfect when you are neutral to slightly bullish. Basically, when you expect the stock to move very slowly or stay flat like in a consolidation. And I want you to think of it like renting out your shares, right? You are pretty much collecting the rent whether or not they move out. That's the good thing about covered call. And to me, I just feel like it's a money glitch. Like it's one of the easiest ways to turn your long-term holdings, right, your stock positions, into consistent cash flow without needing to predict every move in the market. And this is also why like the rich get richer, because the rich who knows how to trade options, they're earning free money. Now, let's talk about one of my favorite defensive strategies called the protective put. This is perfect if you already own shares, but you are worried that the stock might drop. So think of it like insurance for your portfolio. So let's say today you own Tesla shares at $250 and you are worried that it could fall, right? Because Trump's mouth just opened, or Jerome Powell is saying that they're going to be increasing interest rate, whatever, right? So you are pretty much bearish on the stock market as a whole. So you're thinking that it's probably going to drop. So what happens next is that you can actually buy a put option with a $240 strike price. And you can see that it's like pretty much this blue line that you can see right here. And once again, this gives you the right to sell your Tesla shares at $240, no matter how low the price actually falls. Now look at the chart. The gray dashed line over here is what happens if you only own the stock. So if your Tesla drops, your losses also drop, right? Your losses just keep on increasing with no limit. But look at this blue line right here. That's your protected position. Below the $240 strike, your loss just flatten out. That's because your put is actually gaining value as the stock falls. In short, once Tesla drops below $240, the put's profit actually offset your stock's loss. So even if the stock crashes, your downside is capped. Quite simply put, instead of losing, let's say, $50,000 because of this crash, you might lose just $30,000 because you have actually making money from like this protected put position. Now, once again, of course, there's no free lunch. In order to get this protection, you pay a small premium upfront, which is just like your insurance. And if Tesla never drops, the put expires worthless and you lose that small premium. Okay, but your 100K Tesla position, your investment, it is still safe and intact. So just to summarize, you keep your long position, you cap your maximum loss, but you do have to pay a small cost in the form of insurance, in the form of the premium pricing, in order to get peace of mind. Now, this is a great move if you want to stay invested, but you want to protect yourself during volatile markets where there's a lot of uncertainty and you know that the entire market is going to crash, but you want to like kind of reduce your losses. So it's kind of like a hedge sort of shit, right? So think of it as like paying $2,000 today to sleep well, knowing that your 100K Tesla position is insured. Now let's talk about one of the most underrated income strategies, the cash secured put. This one is a favorite among long-term investors because you are literally getting paid to wait for a stock that you already want to buy. Like you are getting paid to buy a stock at a discount. It's like pretty much like a no-brainer. So let's say Apple is trading at $260 and you only want to buy it when it drops to $250. So what you can do in this particular case is that you can sell the put option at that $250 strike price and collect a premium upfront, say $5 per share. So once again, free money. That's $500 in instant income just for agreeing to buy Apple at a price that you already like. Like you're gonna buy Apple stock at that price anyways. So why not get some free money while waiting? Now take a look at the chart. The green line over here shows your profit and loss. If Apple stays above $250 by expiration, the option expires worthless. And you just keep that $5 premium as pure profit. Free money. And this is exactly why the green line here just plateau and stay flat above the strike price. Once again, just to show you that your upside is pretty much capped at the premium that you collect. But if Apple drops below $250, you will be obligated to buy the stock at that price. Like you must buy the stock at that price. Okay, that's the kind of like the downside of the cash secured put, right? That's like the price you have to pay. So below this blue dash line, which is your strike price, you start taking a loss. Just like if you had bought the stock. The good news here is that your effective entry price is much lower, which is $245 instead of $250 because of that premium, the $5 premium that you have just collected. So in other words, you get paid the premium in order to buy Apple stock at a discount. So just to sum it up, you sell a put at a price that you want to buy the stock at, and you earn cash while waiting, which is once again in the form of the premium. But the price for this particular strategy is that you must buy if it drops below your strike. Like you must buy, okay? So this strategy works very well if you are neutral to slightly bullish and you want to build positions without chasing price. And I want you to think of it like placing a limit order that pays you while you wait. So those are the 5 foundational option strategies that every trader should know. Obviously, there's a lot of like other advanced strategies like the Iron Condor strategy, and like there's a bunch of like other very complex strategy which I don't really want to go through in here to avoid confusing you guys even further. But basically, these 5 strategies, they are simple, they are logical, and they're built around one goal, which is control. Control over your risk, your timing, and your psychology. So quite simply put, just to summarize everything again, covered call is when you're earning income from shares. Protective put is when you protect your downside. Long call is when you're betting on upside. Long put is when you bet on downside. And cash secured put is when you get paid to buy cheap. Okay, so you don't need complex spreads, you don't need complex indicators or complex strategies. Just master these 5 and you will already be ahead of 90% of option traders who don't even know what they are doing. So now that you know the top 5 strategies, let's talk about how to choose the right one. The truth is, the best traders, they don't use random strategies. They pick based on the market conditions. If you expect the stock to actually go up, then you want to be using bullish option strategies like long call or a covered call. If you expect it to go down, then you want to be using a long put or a protective put to hedge your downside. Now, if you think that the stock will stay roughly the same, like doing like a consolidation or like a sideways market, then you are much better off using a cash secured put. This helps you earn passive income while waiting for a discount. This is perfect when there's a lot of uncertainty in the stock market. Okay, and the point here I'm trying to make is that you don't want to be trading based on excitement. You want to trade based on the environment, based on what the market is actually doing, based on the market cycle, the market regime right now. So now, before you place any option trade, you need to go through a very simple 3-step process. Now, this is my exact framework, and I'm going to show you how I personally analyze options on Interactive Broker. So let's dive into it. So inside Interactive Broker, if you just select any particular asset that you want to be trading, right? Let's say we want to look at Apple stock or Amazon stock or Tesla stock, you can just click on them right here on your watch list. And then if you click on chart, this is where you will be able to look at what price is doing based on the candlestick charts, right? And that's always going to be the first step, is to make sure that you are preparing your charts, you are marking up your charts so that you can identify the trend direction and you can be on the right side of the trend direction. So let's look at, say, Apple stock right now. So if I go to charts right here, I will look at the structure, I'll look at the trend, I'll look at the context. So very simple, if the chart is creating higher highs just like this, higher highs, higher lows, higher highs, higher lows, price is in the uptrend, okay? We are in a bullish environment. Now, if price is creating lower highs, lower lows, just like this, price is in a downtrend, which means we are in a bearish environment. And if there is no clear structural highs and lows forming, and price is just moving sideways, just like this, you know, stuck between your support and resistance level, your supply and demand level, that's just the market being neutral, right? That's just the market being a wanker. Nah, just kidding. So it's just not really doing anything, right? So please don't overcomplicate it. That's pretty much how you tell your trend direction, right? Look at the market structure and let your buyers decide your strategy. Once you label the environment, bullish, bearish, or neutral, everything else becomes mechanical. You know exactly what option strategy you want to be using. Step 2 is to check the volatility. So what you can do is to go to option analysis, and this is where you can check the volatility. The 2 main things that we're going to be looking for is the implied volatility and the historical volatility. Volatility basically tells you how expensive options are. When volatility is high, option prices are inflated. That's when it's much smarter to sell options and collect premium, like what we do with a covered call or a cash secured put. When volatility is low, options are cheap. So that is when it makes a lot of sense to actually buy options, like long calls or long puts. And I want you to think of volatility like the weather. When the market is stormy, you want to sell umbrellas for a premium. When the market is calm, you want to buy them cheap before the next storm, right? So that's like a very simple example. Anyways, inside Interactive Brokers, like I said, these are the 2 volatility indicators that you want to focus on, right? The implied volatility and the historical volatility. If the implied volatility is above the historical volatility, this means that options are expensive, which means it's better for selling. If your implied volatility is actually below the historical volatility, that means options are cheap, so it's better for buying. By the way, here's like a pro tip, right? Like there's this option wizard thing, which I never really used it before, but like this is super duper useful if you want to actually try to apply your option strategy. Anyways, let me just go back. All right, let me just not get distracted because Interactive Brokers is awesome. So step 3 is to actually find out your time horizon, right? So you go to option chain right here, which is pretty much where we usually execute our trades. This is where you want to decide how long you want to hold the trade for. Because, we all know the term time is money. But in options, time is literally money, okay? So in the option chain, you will see all the different expiry dates that we have up here. This number shows you how many days to expiration. 4 days, 11 days, 11 days, 18 days, so on and so forth. Short-term options, which is anywhere from like 7 days to 14 days, these are the options that decay super duper fast. So they are high risk, high reward. And then you got medium-term options, which is spanning from around 30 days to 60 days. This gives you a balance, okay? Like it gives you sufficient time for your trade idea to work out without overpaying. And then you got long-term options, which is also called leaps. They move a lot slower, but they give you breathing room for bigger swing or investment plays. And once again, most beginners lose not because they don't know how to analyze the charts. They lose because they choose expiries that are way too short. Remember, you can be right about the direction and still lose money if you are wrong on the timing. So just do yourself a favor and just always give yourself enough time for your trade idea to play out. Okay, so inside Interactive Broker, the checklist looks like this. You look at the charts for buyers, bullish, bearish, or neutral. And then you go to the option analysis to see if volatility is high or low. And then you go back to the option chain to pick an expiry that gives your trade ideal sufficient time to work out. Right? So that's pretty much like your pre-trade checklist. Once you do that, then the next step is to just choose the right strategy. And it becomes so mechanical and easy to do that because now you have like this structure and order in your pre-market routine. Like you will instantly know whether to buy a call or sell like a put or like do something more advanced later on. Okay, now that you understand the pre-trade checklist, let's actually apply it on a real stock so you can see how everything connects. So for the sake of this example, we're just going to use Tesla because it's one of the most traded stocks for options since it's very liquid, very volatile, and a lot of opportunities, and it's just perfect for learning. So step 1, go to the charts, read the chart, read the market direction. And if you look at Tesla, we can actually see that it's been trending up pretty consistently, right? It's creating your higher highs, higher lows, higher highs, and higher lows since like the midsummer. And right now it's pulling back a little bit to around the $420, right? This is like a very huge meme. If you know, you know, right? 420.69, hashtag Elon Musk. Okay, but anyways, right now it's pretty much pulling back to around this 420 area, but it's still holding above structure, which once again tells me that buyers are actually in control, right? The demand has actually overpowered the sellers. Once again, I'm not gonna go too deep into technical analysis in this video, right? Because I got a lot of training on that, right? So if you want, just go and check out the rest of my videos on how to analyze the charts properly. For this video, I just really want to focus on showing you guys how to trade options. So in this particular case, my bias is going to be bullish, all right? So price high, creating higher high, higher low, higher high. Right now, price is pulled back to the 420 demand zone right here. There's a very high chance that it's going to create like a higher low right here and just continue going up and take out all-time high and just take out this 470 level. So bullish bias. And based on that, I'm going to be using a bullish strategy, probably a long call or a cash secured put. The next step is to check the volatility to see whether options are cheap or expensive, right? And you can see, if you look at this, you will notice that Tesla's implied volatility has pretty much came down recently, right? From around like 3.65% to around like 3.33% lately. This drop right here pretty much tells me that the option prices have come down and they are getting cheaper, which is good. And this is a good environment for us to buy options. Like we want to be buying anyways, rather than sell them. Now, if the implied volatility was actually spiking up, like just absolutely skyrocketing, I'll flip that logic and I would sell options instead to collect the premium. Third step is to pick the expiry, right? So let's go to option chain. And this is where, once again, you will see the week expiries, like the 4 days, the 11 days, the so on and so forth. And since I'm taking a directional trade, I would usually go for about 30 days till expiry, right? So maybe like these 32 days right here. That will definitely give enough time for the trade to play out without paying too much for time value. Step 4 is to pick the strike price, which is where we think price will actually go, right? That's our target price. So right now, Tesla's trading around $441. So I'm pretty much looking like at a price above that as my strike price, maybe 445, right? Once again, very realistic that price will eventually get to 445. I personally think that it's going to get to like 470 as well. But once again, just want to be conservative, right? So let's say like 445. So let's say we go for the $445 as our strike price, and then we want to go for like a long call position. So if that's the case, the premium is probably around like $20 to $22.73. The premium is probably around like $22.73, right? Which means that we will need a total of 22.9k if you are entering for 10 contracts. And if you enter just for one contract, that's around like 2.2k, since each contract represents 100 shares. Now look at the delta column that we have right here. For this particular strike, it's around 0.471. That means roughly a 47% chance that this option expires in the money. And this also means that if Tesla goes up by about $1, the option price moves about $0.471. So once again, delta isn't just about the probability, it's also about the sensitivity. Your max loss is pretty much this, okay? Like this is pretty much the 2.2k premium that you pay. That's your max loss. So if Tesla doesn't go up to 445 in 30 days, in 32 days, right, by this particular date itself, you lose $2,200. But if Tesla keeps climbing, your upside is unlimited, right? So once again, limited downside, unlimited upside. This is why it's great for beginners. Now, once again, remember Theta, our best friend. That's the price you have to pay in order to trade options, right? That's the time decay. Every day that passes by, your option loses a little bit of value. The decay accelerates in the last 7 days before the expiry. So even if Tesla stays flat, your option can still drop in price just from time passing. And this is exactly why we tend to pick expiry dates that give our trade ideal a little bit room to breathe. So here's the final setup, right? Tesla trend, bullish. Volatility, moderate, right? So buying makes sense. Expiry around 32 days. Strike price around 445. And we are going for like a long calling position. The risk is around $2,200. And the reward, the upside, is unlimited. So that's pretty much how you combine chart structure, volatility, and timing to build a clean, high probability option trade. Now that you have seen how to plan and enter an actual trade, let's move into strategy. The 5 core ways to trade options depending on whether you are bullish, bearish, or neutral. So to help your dumbass out, here's a simple cheat sheet. Your strategy selection map. If the market is bullish and the volatility is low, buy a call. That is when premiums are cheap. Now, if it's bullish, but volatility is high, sell a covered call. Collect the premium instead of overpaying. If the market is bearish, you either buy a put when the volatility is low, or you use a protective put when it's high. And if the market is neutral, volatility is high, like the bulls and bears are playing a tug of war and no one seems to be winning, this is where you just want to get paid for waiting. So you just sell a cash secured put. So I want you to think of this strategy selection map like a GPS. It will help you pick the right strategy, the right route for the conditions that you are driving in. Okay, so make sure you pair the right strategy with the right market condition. So that's how you analyze, set up, and enter an option trade step by step. But here's the thing, placing the trade is the easy part. What separates professionals from beginners is how they manage risks. Because if you don't manage risk properly, even one bad option trade can wipe out 10 good ones. And like what I always tell my students, risk management is a love letter to your future self. And you're the only one responsible for delivering it. Write that down somewhere, right? Because I came up with that and I was like, holy shit, that is so poetic, right? Like there's no better way to put that. So let's talk about the golden rules of risk management when you are trading options. Rule number 1, only risk what you can afford to lose. I know, super duper cliche, Warren Buffett said it, right? Everybody says it. But the thing is, in options, your losses can add up very, very fast, especially if you over leverage. So always make sure that you know your maximum loss and be comfortable with losing that amount of money before you actually enter into the trade. Okay, for buyers, it's easy, it's just a premium. For sellers, it can be much larger. Rule number 2, never sell naked calls without protection. This is one of the biggest beginner mistakes. A naked call means you sold a call without owning the stock, which means your losses are unlimited if price keeps rising. And this is why professionals, they always hedge with a covered call or a spread. So remember, if you only sell options, always define your risk. Rule number 3, always size your trades based on the total portfolio risk. For example, if you have a $10,000 account, please don't put $5,000 into one option trade, okay? I personally never risk more than 2% to 3% of my account on a single trade ideal. The most I'll do for like an option trade is like 5%, like that's the max. I'll never ever go above that no matter how confident I am in the trade ideal, because anything can happen at any point of time. And consistency in trading doesn't come from winning every time. It comes from surviving every loss. Rule number 4, diversify your explorations and strike ranges. Don't put all your eggs in one basket. Don't put all your trades expiring on the same Friday, okay? Spread them out. Some short term, some 30 days out, so you're not exposed to one day of volatility. And please, don't pick all strikes around the same level. Just diversify your positioning to smooth out the results. Now, I want you to quickly visualize this, right? Think of this as like a risk pyramid. At the base, you have your safest setups, right? Which is your covered calls, your protective puts. In the middle, you have your directional trade, which is your long calls and your long puts. And at the top, you got your speculative plays, which is short-term out of the money options. Okay, and the higher up you go on this pyramid, the smaller your position should be. If you follow this pyramid approach, you will never blow up your account, even if you hit a string of losses. Okay, so just stick to the risk parameters, because risk management is what turns options from gambling into a consistent business. Now, beginners, listen up. I don't want you to lose money. I want you to become a better trader, okay? So let's talk about some of the most common mistakes that cause beginners to lose money with options. Once again, these are the mistakes that I personally committed, right? And I believe every single beginner will potentially commit if they don't actually understand this. As the saying goes, a smart person learns from his own mistakes, but a wise man learns from the mistake of others. Okay, so these are the things that separate professional gamblers from professional traders. And once you understand them, you will already be ahead of 95% of the losing traders out there. First mistake, chasing cheap out of the money options. A lot of new traders, they see a Tesla call for $20 or $30 and they think, oh my God, this is so cheap, I'll just buy a few. But cheap doesn't mean it's a bargain. It usually means that the probability of profit is extremely low. So far out of the money options are like lottery tickets. They look exciting, but most of them just expire worthless. Instead, what you should be doing is to focus on at the money or slightly in the money options, where the delta is around 0.4 to 0.6. Those give you a higher chance of success and smoother price movement. Next, time decay. Like I said, our best friend, right? Or what we call Theta. Every option you buy is simply a wasting asset. It's a depreciating asset just like a car. And as each day passes by, that premium loses value, especially in the final 2 weeks before expiry. And beginners, what they often do is that they hold the trade too long. They wait for the perfect move, but by then, Theta has already eaten away all their profits. So don't just look at the direction, look at the time left, right? Look at the time left on the bomb, okay? It's gonna explode very, very soon. It's gonna explode right in your face if you don't actually look at the timer. And when you trade contracts that expire in just a few days, the Theta decay goes absolutely parabolic. Every hour matters. Most beginners, they buy weeklies because they're cheaper, but that's really where like the time decay kills you the fastest. So if you're new to options trading, just avoid trading any options with expiry dates of like less than 7 to 10 days, because the time decay just accelerate aggressively near the end, and that's when most beginners get wiped out. So a simple rule of thumb is this: avoid buying weekly options unless you are scalping a move. Okay, unless you are really scalping and betting that price is going to go up in like the next few days or the next few hours. For swing trades, 30 to 45 days till expiry is like the sweet spot. The third mistake, over leveraging. Okay, just because you can control $50,000 worth of stock with $1,000 doesn't mean you should. This leverage goes both ways, right? High risk, high reward. A 10% move against you can wipe out your entire position instantly. Professionals survive because they risk small and they compound consistently. Not luck, not chasing higher returns. Okay, so my personal rule is that never ever risk more than 2% to 3% of your entire portfolio on a single option trade. Like I said, you don't need higher returns. You need fewer stupid decisions. Next, trading earnings blindly. Once again, this is another big trap. A lot of beginners, they love buying calls before earnings, right? Because like they love gambling, they love the adrenaline, and they're expecting price to go to the moon. But the next day, even if the stock goes up, their option still drops in value. What are you talking about, Brad? I should be making money. So why am I losing money even though the stock goes up? Well, that's volatility crush. Before earnings, the implied volatility spikes up, inflating option prices. And after earning, volatility collapses because there's less traders in the market right now and all the premium gets sucked out. So unless you understand implied volatility and how to price that in, much better off just avoiding buying options into earnings. Or better yet, selling premiums after that spike, not before it. Now, once again, when volatility spike up, beginners, they rush to buy options because they think it's opportunity. But high implied volatility means that you are just paying more for the same exposure, right? The options is just more expensive. So unless you expect volatility to rise even higher, you're essentially fighting against time decay and the premium crush. Professionals, on the other hand, they sell volatility when it's expensive and they buy it when it's cheap. And you always want to make sure that you're on the smart side of that equation. Next, selling naked options. Now, this is pretty much what we just mentioned, right? Selling options, super powerful. But if you do it without protection, your losses are going to be unlimited. So unlimited losses, okay? You don't want that. So imagine you sell a call on Tesla at $400 and it runs to $500. You're now down $10,000 depending on your size. So always make sure you use defined risk spreads or covered calls if you're going to sell. Okay, so I always say this. Professional traders define the risk. Amateur traders hope it doesn't happen. And hope is pretty much something that doesn't exist in the market or doesn't go well in the market. And finally, the biggest silent killer, having no plan. As the saying goes, if you fail to plan, you plan to fail. Same shit right here, okay? Most new traders, they enter into a trade with a dream. Oh yes, Tesla is going to go to the moon. Please, Jesus, let Tesla go to the moon. That's not how it works, okay? You need to have structure and you need to have order. So always make sure that you know 3 things before you enter for the trade. Your entry price, your stop loss, which is the price point that invalidated the trade ideal, which is the price that you want to get out of if the trade doesn't work out, and your take profit, your profit target, right? Which is where you want to get out if the trade does go in your way. And a simple rule of thumb is to take profits when your option doubles and cut it if it loses half its value. That one rule they just tell you, it can save you from blowing your account and losing tens of thousands of dollars. So remember, the goal isn't to be perfect. It's to avoid the stupid mistakes. It's to avoid the obvious mistakes. Because when you stop bleeding from rookie errors, guess what? You are losing less money, which automatically means more profits. Because that's the only constant in trading, losses. So if you can think about just avoiding these mistakes, reducing the losses, easy money, free money, right? More profits. And as a result, consistency will naturally follow. So once again, you don't need to trade smarter than everyone else. You just need to make fewer stupid decisions and make fewer stupid mistakes. Just lose less while you learn. Lao Tzu once said, a journey of 1,000 miles begins with a single step. For traders, that first step isn't opening a live account. It's understanding what you are doing. It's learning the craft, building structure, and training your mind before you even reach a single dollar. And that's exactly what I'm going to show you right now. How to go from zero to profitable in 6 months, step by step. Step 1, start with paper trading. If you're brand new, please don't jump straight into live capital. All right, I've been burnt so many times. I myself blown 5 accounts, failed 6 funding challenges, and lost over $10,000. All right, pretty much just lost a lot of money my first year because I was rushing the process. So you're much better off starting with paper trading on platforms like Interactive Brokers, Thinkorswim, or TradingView. And once again, the goal here isn't to make money. It's to build muscle memory. Is to make sure that you get so competent at analyzing the charts that it feels like second nature. And this is where you can learn how orders work, understand strike price, expiration dates, time decay, and just practice managing your trade. Step 2, build the skill, backtest, journal, and then review. I know that sounds like an arduous journey, like it sounds like a chore, but the difference between amateurs and professionals is not their strategy, but their reflection. At the end of the day, the work just needs doing. And not only does it need doing, it's about reviewing it as well. Okay, so it's not just about doing the reps, because if you do the reps every single day, but you still continue to repeat the same mistakes, repeat the same unconscious patterns over and over again, guess what? You're just going to compound your losses, and nothing changes if nothing changes. So it's about doing the reps and reviewing. Every trade you take is a feedback. So journal it, review it, backtest your trade ideas, your trading strategy, learn how to refine your entries and track what's working and what's not working. And then just do more of what works and less of what doesn't. Practice doesn't make perfect. Practice makes permanent. Practice plus feedback makes perfect. Step 3, this is a shortcut, right? If you want to shorten your learning curve, join the 1% Club. Learn, trade, get coached daily. Once you've built that foundation, that's where the 1% Club comes in. I created it for traders who are tired of guessing, tired of gambling, and ready for a proven mechanical system that just works. Inside, we don't just teach trading strategies. We build traders from the ground up, taking them from amateur to 6 figures and even 7 figures. So basically, you will learn how the market truly works, build your mindset and master price action, master market mechanics trading. You will learn risk management, build your own mechanical trading system, and journal and review your trades like a professional. You will develop emotional mastery, get funded and scale like a professional. And you will trade alongside me and my coaches with 20 years of combined experience every single day. Okay, so we got Jason who's handling the technical precision, you got Sanjeev who's handling the psychology, and then I myself, I handle performance and execution. So once again, this is not theory, okay? It's practice, feedback, and accountability every single day. Step 4, get funded, scale, earn consistent income. I know this is the step that everybody wants to get to, right? That's the end goal. It's very simple. It's to become a consistently profitable trader who can generate 6-figure income with structure and confidence. Over 1,500 of our students have already gotten funded using the exact roadmap right there. Remember, you don't become successful from one winning trade. It's built over thousands, executed with discipline. And the 1% Club, it gives you the system, the feedback, and the support to make that happen. So, if you're serious about becoming a profitable trader, not in theory, but in practice, this is your path. It's the same process that took me from trading $20 accounts in my broke bedroom, in my dirty little bedroom, with my cracked iPhone 7 with like a home button, to now making 6 figures a month. All you need to do is to commit, follow the roadmap, and let us guide you every step of the way. And remember, you don't rise to your goals. You fall to the level of your systems. Build the right system and success becomes inevitable. Alright, so last night we actually entered for like a long call option trade on Tesla. We bought about 45 contracts of the 442.5 call strike calls, which is expiring in about 4 days from now on October 31st. And right now we are up about 36.9k in unrealized P&L. So the reason why I actually entered for a long call option is because I was extremely bullish, and I think that Tesla is just going to continue going up and potentially coming up to like at least this $460 level, and even coming up to this $470 level, right? So that's pretty much me, being bullish in a trend direction when it comes to Tesla. And I'm pretty much expecting it for it to do so within the next few days, right? So this is more of like a scalp option trade. Once again, it's all about understanding liquidity and timing. So you can see what happened was that last week, we got price coming down here, sweeping all the available liquidity that was sitting below these lows right here. So this was pretty much the first time that institutions actually got in for the long position. So now, this week when the market actually opened, price pulled back and mitigated this imbalance that we have on the left-hand side, right? To fill up the remaining buy orders, right? Maybe this is where institutions, they start scaling in for the buy orders. And then right now, when the market actually opened, it started pushing to the upside, right? Yesterday when the market actually opened. So you can see New York session liquidity pretty much drove price up. So we pretty much got a piece of that. We entered, I think, somewhere around here, like I said. This is pretty much the strike price which we entered at, right? It was more of like an in-the-money option. So yeah, pretty much expecting price to continue bullish and coming up to like at least this 460 to even like this 466 area, right? I want to be ambitious and try to target this high right here before the option actually expires. But I also like to be conservative, somewhere around here. I'm potentially good, right? I'm just looking for price to actually get up here. If price can get up here before the expiry, then I will decide what to do next. Based on the momentum that it presents around here, I will decide whether to just continue holding the trade all the way to expiry so that I can have like more upside, unlimited upside, or I could potentially close the trade manually before it actually expired if it lands somewhere around here, right? So I need to see what's the momentum that price actually creates around here. So let's see what happened when the New York Stock Exchange actually opened today. And then based on that, we can decide what's the best course of action. So at this point, my break even is probably around like the $459 level. If price can potentially push up towards like the 460, the 465 range before expiry, this is where this position could easily close at 90k to around like 100k in profit, right? So that's pretty much what I'm looking forward to. But the downside is that if it drops below, it drops back to like 445, this is where I will potentially start to look to trim the position or even like take profit manually, because time decay is gonna speed up like crazy before the option actually expired. Anyways, like the key takeaway here is that it's not about just guessing the direction, right? You need to be right in terms of the timing. It's about understanding liquidity, spotting liquidity, timing it properly, ensuring that you're right in the fact that the market is going to move in this particular direction, in this amount of points at this time, right? And just really being right about the time horizon and just managing risks. Like I said, man, every single trade that I take follows the same mechanical checklist, which involve structural, right? We are in a bullish structural on Tesla right now. Involve liquidity. We had literally see price mitigating like this previous imbalance that we have right here. That swap liquidity, right? This entire demand right here. And it also involved timing, right? Just ensuring that I enter to capitalize on like the New York open liquidity. So yeah, right now I'm just going to continue holding on to the trade. Like I said, I do think that there's a very high chance that price is going to go up to this 465 range, at least this 465 range. Not sure about whether it can take out this 470 high, but at least this 465 range. And that is good enough for me. All right, so yeah, let's just continue being patient and see where this option trade allows us to end up at. All right, day 2 of our long call option on Tesla. So right now we're up about 68k, and last night price actually went all the way up to the 468 level before it started pulling back a little bit, right? Which we pretty much expected the price to do, because obviously there's a huge amount of supply at this price point right here, at this 468 level. You can see there's a lot of imbalance that we have on the left hand side. So this is more of like a reminder to myself, but you don't need higher returns. You need a longer runway to compound your returns. Think about it. 5% per month equals to 60% per year. And if you start with 10k and you stay consistent for 10 years, you will end up with 1,099,511. You will end up with $1 million with 10k. Just having skill and letting it compound over time, over the next 10 years. The outsized returns only comes when you dare to travel outside of comfort zone. It's like this is the comfort zone, this is the outsized returns. And they are not together. Like you have to actively learn how to let your winners run high so you can get the outsized returns. Anyways, if you are ready to stop gambling and start trading like a professional, check out this video next, where I'll walk you through step by step on how to go from 0 to becoming a 7-figure trader. Step by step, yes, it's my entire blueprint to becoming a millionaire trader. And I'm giving it to you for completely free. So check it out right there. And always remember, you're just one trade away. Mwah.